of Sales Development and National Accounts, and he's been with us going on right about 10 years or so now. And today, we're looking at a very popular sales concept, college funding. Now, before I hand the controls over to Jared, I just want to remind everyone that today's session is being recorded, and you will receive an email with that recorded link. Take a quick look at that GoToWebinar toolbar for me. You'll notice there are some handouts that are available for you to download. And if you have any questions, be sure to go and use that question box, and we'll get those answered as soon as we can. One more quick thing. If you're using your computer for audio, and if it happens to cut out or it seems to drop off, please feel free to dial in by phone, and you're going to see that number over in that GoToWebinar toolbar as well. Again, thanks so much for joining us. Jared, over to you.
All right. Perfect. Well, thank you, Stacy, and thank you to all of you for taking the time to join me today. Today, we're going to be talking about a subject that is on the minds of anyone that has kids. You know, my wife and I have 3 kids, ages 8, 11, and 14, and this is always on our minds. We ask ourselves, you know, are we putting enough away for our kids' college? Are we putting enough into the right type of savings vehicles? Because as you know, there's a lot of opinions out there as to how you should save for college. What if plans change? Will our strategies still work? And then finally, is there a better way to do this? And these are the exact same questions that your clients are asking themselves and also asking you. So in our time together today, we're going to be talking specifically about one option you can provide to your clients to solve their college planning questions, and that is using a properly structured life insurance policy. Now, my goal in our time today is that by the end of the presentation, you would have clients and prospects that come to mind that you can approach with this solution. So make sure to take some time to write down those names of people that come to mind, and then reach out to your MGA or to your contact at North American so that we can help you turn those names into some revenue in your pocket. Here's some disclosures for us. So on our agenda today, first, we're going to take a look at the reality that your clients are facing when it comes to college costs. Next, we're going to take a look at why life insurance for college funding. And then finally, we're going to go through a sample case study and discuss some key items to consider when presenting this to your clients. So let's go ahead and get started here in our agenda. So as we all know, college education costs have become incredibly expensive. And as you can see here, costs vary from college to college, but among nationally ranked universities, the average cost of tuition and fees for the 2019-2020 school year was $41,426 a year at private colleges, $11,260 for state residents at public colleges, and over $27,000 a year for out-of-state students at state schools. And this is according to data that came from the U.S. News in an annual survey. So you think about that, for a 4-year degree, you're looking at a low-end cost of about $45,000 for an in-state public college, up to a couple $100,000 for a private college education. And I'm sure all of you on here are able to think about, you know, some different examples of clients you've had that their cost is considerably higher than even that. And so, of course, this is something that's on your clients' minds, as the cost could easily rival their most expensive asset, like their home. And another thing to think about is this rising cost may become a large deterrent to students deciding to go to college, which is why it's really important to have a plan that can change without penalizing the parent or the child. So now let's take some time to talk about how life insurance can be a solution to your client's college planning dilemma. You know, as you can see here, the most important reason as to why you should consider life insurance as a part of your client's college funding strategy is also often the most overlooked. You know, a lot of times we think about the tax-free loans that could come out, and we think about, you know, the ability to access that kind of as we go. But the most important piece is really the self-completion. You know, there's other plans out there. There's 529 plans, education plans that are also great vehicles to save for college, but none of them have the self-completion that life insurance has, which, as you all know, that comes in if there's an unexpected death. There's self-completion that works, but also with our permanent products as well as our term, we have the chronic, critical, and terminal illness benefits that also help to self-complete a plan if something happens along the way. And we want to make sure that we're building plans that work under a variety of circumstances for our clients, not plans that only work under a very specific set of circumstances, which is also why, we should consider putting this life insurance coverage on the parents versus on the child. And I will actually look at both of those options with you here in a little bit, but we're going to focus in on making sure that the funding mechanism, which in this case is the parents, that they are properly protected before we look at putting anything on the children. So let's go ahead here. So a few other reasons to consider using life insurance is, number one, because it isn't a qualified plan, there's no funding limitations, as long as your clients can qualify from an income and asset standpoint. So, of course, in the underwriting process, we're going to make sure that they have enough income to justify, the amount of life insurance that we're looking at, or enough assets to justify that. But outside of that, there's really no funding limitations. The second thing is, with life insurance, you have tax-deferred growth versus, if your clients are trying to save for college using a savings account or mutual funds, which is what I used to see with a lot of my clients. And what they don't realize is that on an annual basis, they start to receive those 1099s on the taxable gains that come from those different things. So we have the tax deferral inside of the life insurance policy. And then number three, as we're all well aware, when it's structured properly, life insurance can provide tax-free loans to be used as your clients see fit. One other reason that isn't listed here is a huge one, in my opinion, and it's flexibility. Now, maybe it's just me, but occasionally I'll have an unexpected expense come up kind of along the way of my plan, or an expense that occurs before my children are expected to head off to college. A good example of this for my own self would be that my oldest daughter just recently turned 14 and got her driver's permit. And so the next thing she wanted was a car. And so, if I were strictly only saving inside of a 529 plan or something else like that, I wouldn't have access to funds that I could go out and get and use for these unexpected things that come up. However, because I've used this own strategy in my own life, I was able to go out, utilize my personal life insurance policy to take out a loan tax-free and to buy her car. And now I can just pay myself back over the next couple of years. And again, so it gives you the ability to use your money along the way, because as we all know, nothing happens in the true linear fashion that we often start the plans with our clients. So this gives you a lot of flexibility built into your plans. Here's a few other things to consider when you're implementing this strategy. And these are just things to make sure that you're very aware of. So the first thing is non-guaranteed performance. So we're going to be discussing using an IUL, an Indexed Universal Life policy, for this solution. And we're going to be using assumed rates of return, which are not guaranteed, right? They're based on look-backs, they're based on that type of thing. So they're not returned. So I would just make sure, my advice would be to make sure that when you're designing these cases, that you're being conservative in your illustrations. And honestly, our max assumed rates are a lot more conservative today than they used to be due to AG 49 and the way that they have changed that. But as you and I know, it's always better to underpromise and overdeliver, especially when you're dealing with something as important to your clients as funding for college. So just make sure and let them know that, what we're putting this into is non-guaranteed, which is really not a bad thing when it comes to college funding, because the other vehicles that they would be considering are also non-guaranteed. The other thing to make sure we're considering is that there are insurance charges, right? It is a life insurance policy, which means there are costs associated because the life insurance company is taking on the risk for you. So there are charges inside of that. And then the final thing that for you to really think about is when you're working through this with your client, you can solve the problem for them in a couple of different ways. You can either look at it as a defined contribution sale or as a defined benefit sale. So to kind of differentiate between those two, if you have a client that very strictly has a certain amount of money that they can put towards this on a monthly or an annual basis, that's really more of a defined contribution sale, because you're going to work with what they have and you're going to take that and you're going to show them what it could create. The other type of client you're going to work with is those that have an idea in their mind of how much they want to have when it's time for their kids to go to college. They may say, oh, we want to make sure we have 10,000, 15,000, 25,000 available on an annual basis when they're ready to go to college. So you can then work your plan backwards from that and figure out how much, using, again, like I said, conservative rates of return, how much they would be needing to put into their life insurance policy to have that amount available when their child is ready to head off to college. And then, from a policy structure standpoint, here's a few other things to keep in mind as you're building this and working with your MGA and with your North American folks to help you build this. The first thing is we want to make sure that we're avoiding a modified endowment contract. And I will talk about one exception to that here in just 1 minute. But, we're focusing on the tax-advantaged benefits that a life insurance policy can deliver. And to experience those benefits, we need to avoid turning this into a modified endowment contract, because at that point, we make it so that when we take money out, it acts more, if we turn it into a MEC, it acts a little bit more like an annuity, where the money that we take out is taxable up until we take out basically the gains in the policy. And we don't want to do that. We want to make sure that they experience the full tax benefits of life insurance with us. So we want to avoid a MEC. And really the only time I would say where you may want to forget about that is if you have a client that would maybe have a substantial amount of assets in savings vehicles and their child is getting really close to going to college, they may want to consider putting a lump sum into a policy of ours like the Smart Builder or even the Builder Plus 2 that we'll talk about here in a minute. And at that point, you would be creating a modified endowment contract, but that again would be okay. It would give them a chance to put some money inside of that, which would take it out of the FAFSA calculation, but also it would give them a chance to have money set aside that they could use later on to either pay that college off or to use in retirement. And it would just function more like an annuity. The second thing is, make sure you're giving your clients the right amount of death benefit. Generally with this type of sale, when we design it, we're going to bring the death benefit as low as we can so that we grow as much cash as we can in a quick, shorter time advantage. And so I would say the thing you want to make sure to do is if you're designing this on a minimum non-MEC type face amount solve, make sure that you're adding a term on top of it. Because our very first job, as we all know, as financial advisors, is to make sure our clients have the proper amount of coverage so that if something were to happen to them, their families could continue on in the life that they were already providing. And for North American, when you do term with us, I would recommend you use our Advantage term for this type of a sale. So our Advantage term has a couple of things. Number one, it has the chronic, critical, and terminal illness benefits included in it at no additional cost for almost every state. And then the other thing is it's convertible to any of our permanently or currently marketed permanent plans. And the other thing with that is you can actually convert it into an existing IUL that you have with us. So for instance, in this, as we go into the case study here in a little bit, we're going to be using our Builder Plus IUL. And if you were to have put a term alongside of that, then let's say 5-10 years down the road, your client wants to put more money into the IUL, but the way that we've structured it doesn't really allow them to put any more in without creating a MEC. What we would do is we'd convert part of that term and it would just increase the face amount on their current IUL. And you would still get paid on it as though it's a brand new policy. The other thing to keep in mind with that when it comes to the proper amount of death benefit is that we have the right-of-way program now, which is the opportunity for your client to get non-fluid underwriting. And for the ages of 18 to 50, we'll do that up to a $2 million face amount. So just keep that in mind kind of as you're making this sale and showing them an IUL solution, to make sure and add that term on top of it. It's going to be beneficial to your client for sure, but it's also going to help you build up that term bank to convert in the future. And then the final thing is just, make sure you're choosing the proper death benefit option to best solve what's most important to your client. And we're going to look at 3 different options here in a little bit. We're going to look at increasing, level, and then the return of premium death benefit option. And you can decide then what's most important to your client. We've already talked through quite a few of these, but here's a good list of some of the pros and cons to using life insurance to help your clients fund their children's college education. And I would say, without me reading through the whole list here, a few key advantages to make sure and focus on would be 3 main things. And that is, number 1, like we've talked about, self-completion. Most plans that your client would be looking at don't have any sort of self-completion built in. That is our largest advantage to using life insurance. The second thing is control. Plans change. As we all know, the one thing that's guaranteed is that a plan you put together for your client today is going to change over the next 5, 10, 15 years. So you need to build plans that can change. And one of those big changes, obviously, that we're referring to here is, what if their children end up not going to college and they've been saving money inside of a 529 plan or another educational type plan? In those plans, if that plan changes, it can be very disadvantageous to your client. They're going to have some taxes paid and potentially a 10% penalty. So we want a plan that changes with your client. And the third thing to make sure and focus on, in my opinion, would be risk. Most educational accounts, 529 accounts, are invested, which means there's risk involved. Just to give you an example of that, I'm sure you've all experienced it, but I was a financial advisor before I came into the home office. I was a financial advisor down at Topeka, Kansas for 7 years. And at one point, we had a rep leave our office. And so I took over his account. And, not long after he had left and we'd gotten things signed, one of his clients came in to see me, and they had a child that was a couple of years away from college, and they'd been investing in a 529 plan. And, this was right in that 2008, 2009 time frame. And, we were looking at their account, which I had not been managing at that point. And they had lost about 30%, which, no one had been keeping an eye on it to change their asset allocation over as their child got closer to needing to access the funds. And so now they were scrambling to try to figure out, 1, do we stay invested so that we can recoup this? Or there's also the, as you all know, at that point, you don't know if it's going to continue to go down or not. And so that was a risk that they had inside of their plan that really they weren't aware of. That, with our IUL solution, we have a 0% floor. Right now, you can have zeros, and you will have zeros. It is pretty much a guarantee you will have some 0 years, but you're not going to have a negative 30% year. And then from a disadvantage standpoint, the biggest disadvantage, in my opinion, isn't really a disadvantage, but more of a be aware item. And that's something we talked about earlier, and that's that this is not a guaranteed product, right? You don't want your clients thinking that that number on the illustration is a guaranteed income amount that's going to come to them. It will be different. It could be better. It could be worse. And we actually have a great marketing piece. If you're curious how these policies of ours have performed over the years, even through all the different changes, reach out to us on that. We can provide it, and it'll talk about how one of our policies that we issued back in 2005 has performed kind of through this time. But like I said, the amount that's going to come to them, the illustration is going to be different. So make sure to under-promise and over-deliver by being conservative. So now that we've talked about, why life insurance can be a good tool for college funding, let's take a look at a case study. That always helps me to kind of put it into action. And the first thing I'd start with is what we talked about at the very beginning of our conversation. And I said, for this to be a good use of your time, it's really important to me that you come away with this with the ability to turn this into some revenue in your pocket. So real quickly, just make sure, if you have a piece of paper in front of you, to write down the names of clients that are coming to mind that fit this profile. Number 1, they need additional death benefit protection. And, we always put that in these, but I would say there's there's very few, if any, of your clients that don't need additional death benefit protection. We're looking for families that have young children, although there are some things you can do with those that have older children. But one of the biggest things working against us with a life insurance solution is if someone's coming to us when their kid is 15, it's, as you all know, it's very difficult to create something that can get enough money put into it and have enough time to bake to create enough of an income. So think about your clients with those younger children and families that are concerned about, college tuition costs in the future, and they're looking for an option with flexibility and control. So make sure to write down some of those names. So here's our case study. In this case, we have a couple with a 3-year-old child who's going to be going to college in 15 years. Now, the primary breadwinner in this case is the father, who's 30 years old, is in good health, although, they don't have to be super preferred like we're looking at here. But this particular father's in really good health. And he's told you, I can set aside $300 a month for this. That's what we've been planning on to set aside for our kids' education in the future. And then they're hoping that this plan would create $15,000 a year for them in 4 years, which, if you think back to our college education costs, that would be covering them at an in-state school, and would at least be putting a dent in it, kind of no matter where they end up going. So let's take a look at our first solution here. And we're going to use, for really all of these solutions today, we're going to be using the Builder Plus 2 product. And the reason we're doing that is a few things. Let me talk about just a few highlights of the Builder Plus 2. Number one, it's our best long-term accumulation and distribution IUL. And the reason for that is a couple things. Number one, it has our highest cap, has a 10.25% cap on the S&P 500 annual point-to-point. The second thing is this is a product that has a multiplier. Now, multipliers can be very confusing for clients, but when we created this product, we wanted to do it different than most of the companies that were putting multipliers on their products. We wanted to make it transparent, and we wanted to make it easy to understand, and we wanted to put guarantees on it. And again, we want to make it simple for you, simple for your client to understand. So our multiplier is 15% in years 1 through 10, and then 10% in years 11 plus. We also have on this product a contractually guaranteed interest bonus on funds that are in an index allocation of 1% beginning in year 11. And then the final thing I'd say as to why we chose this particular product for this college funding is it has a variable rate loan option inside of it that's capped at a max of 6%. And that begins right away in year 1. They would have the ability to use that. So here's a few key design tips. For this particular one, we're going to be showing an increasing death benefit option, changing over to a level death benefit option in year 15. We're going to be putting in $300 a month for the next 14 years. And we're going to use an illustrated rate of return of 6.27%, which is our max illustrated rate. And, I would always tell you, if you're uncomfortable with that, if you feel like that's too aggressive, go ahead and knock that down. It's still going to look really good for your client. And as you all know, that's based on the AG 49 guidelines. Then we're also going to show a variable interest rate loan of 5.27% to take advantage of that 1% arbitrage. Now, because we're using an increasing changing to level death benefit option, our initial death benefit is going to be pretty low. It's going to be right around $250,000. And like I said earlier, this is why it's really important in this type of sale to add that term on top of it, to give you flexibility in the future, but more importantly, to give your clients the right amount of coverage right away. So we're going to fund this for 14 years, and then beginning in year 15 through 18, we're going to use a variable rate loan to take tax-free loans out of this policy. And in looking at what this would create, it would create $16,716 a year for the client to be able to take out. And if you remember, our client was looking for $15,000 a year, so we've built a little bit of a cushion inside of this right now. So this is one way to design the policy. Let's look at another way here. So now the only difference is we're going to show it with a level death benefit as an alternative way to give them more death benefit protection early on. So by doing that, Instead of starting at 246,000 of death benefit, now we're starting at almost 400,000 of death benefit. Now, the impact of that is, as you can see, our loan had been a little over 16,000, and now we're able to pull out about 13,644 in years 15 through 18. So it does have an impact on the amount that we can take out later on in the policy. However, if it's important for your client to have more death benefit early, this may be the right way to do it. Now, once again, I know you're going to get tired of hearing me say this, but I would still recommend putting an advantage term policy on top of this to make sure to get them to that $1 million, $2 million amount, to make sure they're properly covered so the self-completion really works for their family. The final way we're going to look at this is the way that I would recommend that you actually set it up. And what we're going to do is we're going to utilize our third death benefit option, our return of premium death benefit option. And there's a few reasons as to why I recommend this. Now, one thing you'll notice if you look back is, we're showing about $450 less of income beginning in years 15 through 18 than what we were showing when we were running the increasing changing to level. But as you all know, there's a couple issues with using increasing the level. And that's how I was trained is use increasing the level when you're going to take money out in the future. But the challenge to that is we're looking 15 years into the future. And we're making the assumption that you as the advisor or your clients, one or the other, is going to remember in year 15 to change that death benefit option with the home office from increasing over to level, because that's not an automatic thing that happens. And if it doesn't get changed over and you start taking loans out of the policy, it's going to impact the amount of loans that can come out because the policy is going to continue to try to increase. So that increasing the level looks the best on an illustration, but in reality, there's things that could happen. So with our return of premium death benefit option, this is really your way to fix it and forget it when it comes to increasing, changing to level. So what this is going to do is that it's going to start that death benefit a little bit higher than what it was showing on the increasing the level. I believe that was at 246. So we're a little bit higher on our initial death benefit. And every year that your client pays a premium, it's going to increase the death benefit by the amount of premium that they pay. Now, as soon as they stop paying premium, the policy stops increasing face amount. So again, it automatically changed you from increasing over to level. The other key thing to remember with that is, we've talked about it earlier, it's important for us to have flexibility in the plans that we create for our clients because they never happen the way that we put them on paper in the beginning. So here we're showing that our client's going to pay $300 a month for 14 years. Now, I can tell you my experience when I was an advisor is over a 14-year time period, there's probably going to be multiple times when my client would call me and say, you know what, something happened, something came up, we decided to buy a new car. We decided to, our hot water heater went out. Can we skip? You told us that this life insurance policy you sold us was flexible. Can we skip a couple payments and then get back to it? And of course, you want to tell them yes, because you did sell them on flexibility. So again, if you were using an increasing, changing to level, then that policy is going to continue to go up even when you skip those loan payments, which is going to put some pressure on the cost of insurance charges inside of it. Whereas if you're using the return of premium death benefit option, let's say in year 10, they have to skip a year of paying because something came up. They could do that. It would stop increasing the death benefit because no premiums being paid. And then when they picked it up, it would start increasing again. So I know I spent a lot of time on that, but I think it's really important. If you want your illustrations to look the best and you want to get as much income out as possible, use the increasing, changing over to level. But if you want to show something that has a higher likelihood of happening for your client, because it's more automatic, show the return of premium death benefit option where it makes those changes for you automatically. Now, I know that some of you may be sitting there wondering, why aren't we putting this coverage on the child? They're younger, their cost of insurance would be lower, etc. So we're going to take a look at that alternative. And I would point out that, if the parents are already properly insured, already clients of yours, you've already worked with them, you've gotten the right amounts, you've gotten them the right types, I would always look at putting a policy on their children, just because it ensures, it makes sure there's insurability in the future. It gets them covered. It takes care of the parents, and it does start to build up some cash over time. So there's nothing wrong with looking at putting it on the child. I would just make sure that the parents are first taken care of. So if we do that, you can see here on this 3-year-old, they're going to be standard non-tobacco up until they're 18, and then we can look at changing that rating class. But they're going to be putting in the $300 a month here with an increasing death benefit option, and that's, in this case, it's to keep it as low as possible, the death benefit as low as possible, because one challenge we have is normally we don't like to see face amounts much over $250,000 on a child unless the parents have substantial amounts of life insurance. So for this, we're going to have a death benefit of $438,000, and we're going to be able to take out about $16,100 beginning in years 15 through 18. And if you remember back to that initial design we did, which would be apples to apples, showing the increasing, changing to level, or using the return of premium death benefit option on the parents, we were showing more in tax-free income on both of those. So again, nothing wrong with utilizing the child. I would just highly recommend that you first make sure the parents are taken care of. So the other thing is, you may be sitting there wondering, why are we showing loans and not withdrawals? And if you're like me, when you very first learned about taking money out of life insurance, you always learned that you started with withdrawals to basis and then loans. But with these participating loans, these variable rate loans that allow basically the dollars to stay in the index while you're taking it out, it really is beneficial to you to use loans anytime that you can. And you can see the difference here. If we're using loans like we were showing, they can pull out about $16,700 based on our illustration, or they can lower to that $15,000 and give yourself some room inside of the policy to be conservative. If you're using withdrawals, the most we can pull out is about $11,300. So again, nothing wrong with using withdrawals to basis than loans. It's just loans, with the way that policies are designed today, and that variable rate loan option is going to give them much more potential income coming out of the policy. This, when we take a look at this one here, we've looked at taking care of the children when it comes to it. But as we know, one challenge with college funding is that a lot of times it's to the detriment of the parents' retirement funding. I used to see that with my clients a lot. They would be so focused on making sure their kids were going to be taken care of for college because, they had to pay for theirs on their own, and they don't want their kid to have to do that it would often be to the detriment of their own retirement planning. And the beauty of using a life insurance policy, in this case, the Builder Plus 2 for college funding, is that it's a multi-use tool. And it's not something that, you put money in for one single use and then you pay it down and it's just gone and done, and that asset is out of your life forever. So for this example, we're going to keep everything the same, except we're going to continue to fund the Builder Plus through years 18, even when we're taking money out. So we're going to start with that initial death benefit of $267 because we're using the return of premium death benefit option. We're going to be able to take out about $18,265 a year in years 15 through 18, even though they're only wanting the 15, which again, I would highly recommend just have them take out the 15 and keep a little bit of leverage inside of the policy. And the reason we're able to take out more in this instance is because we're continuing to pay the $300 a month, even when we're taking money out. So totally up to you if you want to do that or not. But here's where I think this is how, when you're positioning with your client, you want to make sure and show them the rest of this. And this is the ability to, yes, help take care of your children's college funding, but almost more importantly, what we're showing here is going out to years 41 through 71. So this would be, from age 71 to age 100. We're going to also take out $39,000 a year in a tax-free loan from our policy to supplement our retirement. And so by the end of this, and there could be all kinds of other things that came alongside this too. One thing that I've seen some very successful advisors do is they'll basically show this to their client and say, here's all the different life events that are going to happen in your life. In the beginning, you're going to be focused on your protection, making sure that if something happens to you, that your family is okay. But the next thing is, your kid's going to need a car, right? They're going to need their first car. So then you could show taking out $5,000, $10,000 of their policy to buy their child's first car. Then the next thing is paying for college. So you can show, we're going to take money out to help supplement, pay for their college. And then going on beyond that, here's where your child is probably going to get married. So at the age of 25 to 30, you show $20,000 coming out of the policy to, pay for part of the wedding. And then, maybe you want to help your child with that down payment on their first house. And then in the future, you show them the ability to take money out for retirement. So you can show them a plan that will, literally be able to help them at every life event that they're going to experience throughout their life. And one other thing, and I know I didn't do an illustration on this, but one thing that I highly recommend showing in this kind of a scenario is don't start the loans when the child goes to college. I would highly recommend considering telling your clients to have their kids take out the loans, right? There's a lot of benefits to taking out the loans. They don't have to pay them while they're in college. So take out the loans, let those accrue for 4 years. And then when your child graduates, pay it off in a lump sum. It's given your policy the ability to grow for 4 more years. It's taken the pressure off of it. You're not taking out systematic loans from it. And oftentimes, it'll then show more money coming out for your client in retirement, when they're taking out that supplemental retirement loan. So just a few things for you to be thinking about as ways to design this. So we also have some pieces that you can take and utilize to be able to show this to your client. And all of this is available out on the marketing toolkit. And so you just go to www.northamericancompany.com/marketing-toolkit. And you can get into that without even signing in. But we have a few different things out there. You can see, one is a brochure that you can use with your clients. And then one is more of an agent guide just to kind of help you through the best way to set this up and some of the key selling points. So I'd highly recommend going out there and checking out what we have available. So here's just a few items to remember that we've discussed today. Make sure you look at all the different options, level, increasing, or return of premium death benefit option as you're setting this up. Make sure to take a look at guideline premium test versus cash value accumulation test. For these, because we have a long time horizon, you're almost always going to go with the guideline premium test. It just works better in those longer term funding situations. Look at standard loans versus variable interest rate loans. And then finally, maintenance, that's just simply making sure you're getting back together with your client on a regular basis to examine how things are going and how they're progressing as you're getting closer to needing to take money out. And the other thing I would add to maintenance would be on those annual reviews, if you have put that term on top of your IUL, that's when you can go back to them and talk about converting part of that term on an annual basis. Just build it into your plan. So in summary, we've covered a lot of things here. We've talked about the reality that your clients are facing when it comes to the cost of college. We've talked about why life insurance could be a great place for them to put money to help supplement that. And then we've talked about, a case study on how you can take all these tools and products to meet your client needs and to make a sale for you quickly. So the bottom line is this is mutually beneficial, right? Most importantly, your client gets death benefit protection, they get tax-free income if it's structured properly, and they get flexibility and control for when plans change, as we all know that they will. And for you, you get a solution to help out with college funding that is a little bit out of the box and also gives your clients, like we said, a lot more flexibility and gives you more flexibility as a planner And then also you get materials to help you grow your business. So the next steps, we've talked about it throughout here, identify 3 clients that really fit this client profile, that have young kids that are interested in making sure their kids have opportunities that they can help them out with in the future. Identify those 3, talk to your MGA, talk to your North American contact, and let's go ahead and turn these into some money in your pocket. Thank you so much for your time. I know that we are right up against it here, but Stacy, any questions that came up?
Jared, great information. Are you sitting down? I have like a ton of questions here. Are you ready?
Yeah, absolutely.
Okay, first thing first, everybody check your chat box. I did send the marketing toolkit site link there, so you're able to grab that link, go into that that site that Jared spoke to regarding product information, sales concept, everything you need right there is at your fingertips. No username, no password required. First question, Jared, is can our InsMark software show the difference between putting the money into an IUL versus other saving vehicles for college options like a 529 plan? Is the InsMark able to do that for us?
Yeah, great question. There isn't, at least in our version, there isn't a college funding place that you can go to that's specifically for that. You may be able to use the other investments versus your policy module. And if you do that, some of the challenges, because I used to put them together in there, some of the challenges are, one, it's normally what you're comparing to is something that you're not looking to exhaust all the funds out of it. So in that, one of the challenges is you're gonna design it in such a way that you need the 529 plan, if that's what you're showing it against, to run out of money in 4 years. And so that can be a challenge, but I would recommend going into other investments versus your policy and just looking through some of the different items that you could use. And there is something that you can kind of make work that way, but there's not something specifically designed for that solution.
Perfect. We did have a question regarding living benefits being available in California, and I will direct you to the marketing toolkit site on that. On our permanent products, yes, the living benefits are available in California. Correct, Jared?
Correct.
Perfect. And then this is a common question, but I don't think it's very well known. So when converting a term policy, if the client already has an IUL policy with North American, they're able to add that to the existing IUL product, correct?
That is correct. And that isn't very well known, but it is kind of a unique feature for sure.
Perfect. And then we did have a question, and I'm going to try and hopefully lump, there's a couple different variations of it on here regarding fees. Now, within our IUL, you did speak a little bit to the multiplier. Can you expand on the multiplier just a little bit for everybody so they understand that and potential fees within that?
Yeah, absolutely. From a fee standpoint, I'd kind of direct you to our marketing guide. But from how the multiplier works, it's an index multiplier. So let's say that the index did 8%, right? And it's in the S&P 500 annual point to point. If you're within the first 10 years, that 8%, we're going to give an additional 15% to that, which would basically be 1.2% additional. So instead of the policy performing at 8% in that year, it would perform at 9.2%. Now, if you're beyond year 10 and now you're in year 11, right? How it would work in year 11 is it goes down to a 10% multiplier. So using the same example, if it had performed at 8%, you would get 8.8%, but also beginning in year 11 on top of that, you're going to get the 1% interest bonus. So instead of performing at 8%, which is what the S&P did, you're going to get the index multiplier at 0.8%. So we're at 8.8, and then you're going to get the interest bonus on top. So you're at 9.8%. So hopefully that little example helps you understand that a little bit more.
Perfect. And that all can be found in our marketing guide too, which is one of the handouts that are there for you to grab. And it also lays out the fees within the policy as well. Um,
Hmm.
that is in that guide too. Regarding death benefit, I mean, we showed all of the death benefit options that we do have available. So a couple
Hmm.
questions came up is how often are we able to change a death benefit in our policy?
Yeah, you can change that. Correct me if I'm wrong here, Stacy, but you can change that on an annual basis. The back and forth from meaning from increasing to level.
Correct. Yep. But once you have the return of premium option, you're not able to change that. So the only time you can change your death benefit
Correct.
option would be from level to increasing or increasing to level.
Correct. Yes. Thank you for
Perfect.
clarifying that.
No, no. Okay. Now, withdrawals and loans. So we have questions on withdrawals being taxed, loans being tax free. Can you touch on some pros and cons there real quick?
Yeah, actually, neither are taxable with the way that we designed it, right? So loans are tax free, and then withdrawals to basis are tax free also. So again, assuming we're not a modified endowment contract, both withdrawals to basis are tax free, and then loans are also tax free. So no variation in those. The biggest reason there was a difference in the amounts coming out versus those two is because with the withdrawals, you're actually taking money out of the policy, right? So that money is no longer working for you inside of your life insurance policy. Whereas when we're taking the variable rate loans, even though it's showing 16,000 or 18,000 coming out, we're actually acting as though that money is staying and getting the index return that we're illustrating.
Perfect. Okay. So we still have questions coming in, Jared. I hope you're still sitting down. Um, one quick thing here, we're gonna go back to the death benefit. Clarify the ROP, return of premium death benefit option.
Okay. Yeah, so the way that works, and again, I'm an example person. So let's say that you had a policy with an initial death benefit of $300,000. Okay, so initial death benefit 300,000, and let's say that you're paying a $15,000 annual premium. Now, every time you pay that annual premium, so the first year we pay our 15,000, your death benefit will increase from 300 to 315,000. Next year you pay your additional 15 and it goes from 315 to 330 and so on and so forth. So every time you pay a premium, it increases the death benefit by that amount. Now, like I said, a few benefits to that are one, when you stop paying a premium, it stops increasing. Unlike the increasing switching to level, which could still continue to increase if you don't switch it over. So hopefully that helps you understand a little bit more on the ROP death benefit.
Perfect. All right. So again, I apologize that we didn't get to some of these questions, but we will make sure and get those taken care of for you. We did run a little bit over time. So on behalf of Jared and myself, we just want to thank you so much for carving time out of your day to spend with us. If some other question does come up when the webinar ends here, please throw that on the survey. And if you do have any additional questions later on regarding our Builder Plus IUL 2 product or the college funding sales concept, don't hesitate to contact sales support or your internal here at North American. Again, just jot it down on that survey for me when it's going to pop up here at the end. So thanks again, everyone. We hope you have a fabulous rest of your day and stay safe out there. Don't forget the toolkit link and don't forget those handouts there. Thanks again, Jared, and thanks everyone for joining.
You bet. Thank you.